Hello everyone, it's me, the Boss Hog, with an investment portfolio update. It's been many months since we had one of these. We've added quite a lot of money since then. We've been through quite the journey, but I'm happy to say we're now above 300k. I'm going to use this video to basically explain what the portfolio looks like, how it's performing, and just to give you an update, really. Let's do it. All right. So in terms of how we're looking, we finally passed the 300k figure. I've technically got four different portfolios, but really I just grouped them all together. These are my stocks and shares, consolidated. My portfolio is at an all-time high, but as you'll see later, that's not an all-time high in terms of profit. So it's a little bit of a nuanced picture. Several of my larger positions, honestly, are significantly below their highest levels. That tends to be the big tech. Frankly, I'm very exposed to big tech. That has been really good for me over the last sort of year, but obviously I've been impacted in a way that you can probably imagine, and that we'll touch on as part of this video. I did decide to move some money in early April from my premium bonds to my ISAs. So that meant that we were able to max out our ISAs in very early April by moving 40k from my premium bonds into that. I also added a little bit more beyond that. So you can see here from the breakdown that we've now got mine and my wife's ISAs, as well as mine and my wife's general investment account. We haven't had anything in our GIAs for quite some time, but we've put 6 grand in over April. If I'm honest, that was mainly because it just felt like too good of an opportunity not to. So I was just cobbling together as much money as I could and moving things around. This does mean, though, that because of how I've set up my Google document, where a single position is allocated to one of the four portfolios, because I've basically got duplicate positions in my general accounts, that my Google Doc is sort of consolidating those into one number. So although the totals are right, you can see here that the breakdown is a little bit off. I will make a small amount of effort, honestly, to tweak the logic in the near future. But it just didn't really feel worthwhile doing, especially because I'm not actually 100% sure if I'm going to be keeping the money in the GIA accounts or if I'm just going to be shutting it down again. So I wasn't sure if it was worth spending the time to do that. On the right there, you can see the snapshots basically taken from Trading 212. Simplistic view, but just to sort of keep myself accountable, I suppose, for anyone who's new to my videos. I don't think it would really be my character to sort of just create fake screenshots, but maybe there will be those people wondering. So I've taken it from Trading 212. The top two there relate to the GIA, hence no ISA allowance bar because it's not in an ISA. And in the bottom two there, you can also see that my approach is to be fully invested with cash. I know some people will keep some cash aside to take advantage of any dips, but that isn't really my style, to be honest. I find it very difficult to have cash in and not go buying. And so, if I felt the need to put more money in, then I'd be converting it from cash into shares almost immediately. So, which is what we did, I guess, with the GIAs. So that's where we're currently at, technically at 303,000. The trading 212 figure there is taken directly from my brokerage, and then the Google Docs is the Google lookups, and the transaction histories and everything else. Typically, I like those to be within about 0.5% of each other, which you can see they comfortably are. Sometimes it does skew, especially if one of the positions is late to close or something from a previous period. But most of the time it's pretty tightly reconciling, so that's great. So that's where we are at a high level, but now we're going to have a look at my positions. I haven't got as many positions as I used to have, so maybe in the future we can spend a bit more time dissecting them, but let's do that next. All right, so in terms of breakdown, you can see here that we're super top heavy. My top three positions account for about 50% of my portfolio. And then I've got a reasonably long tail. There's various reasons for this sort of legacy where I've just didn't really want to sell them for various reasons, or where I'm potentially still building a position, especially the ones there in the US bank and the healthcare position as well. Those are positions that I do plan on building a little bit over the let's say medium term. Similarly as well with copper, which I'm actually very new in. So although here the percentages are very red, I'm actually up on that position just because it's quite new, and similar with uranium as well, which I'm comfortably up on now. But yeah, I've basically doubled down on a lot of my positions. I think that the macroeconomic news, shall we say, is just news and panic and fear, and I'm very much of the opinion that the fundamentals of most of these companies are really sound. I don't consider it in any way like the tech bubble, where you had unprofitable companies attracting ridiculous valuations. Some of the tech is expensive, the likes of Nvidia or somebody like Microsoft. And I must admit that there are some positions, like maybe Apple, I don't really consider deserve the premium that they have. Whereas others like, Google, Amazon, Microsoft, maybe even Nvidia, although that is expensive. Um, to me, they're just amazing companies that continue to look like good bets. Similarly, as well, we've gone now into Scottish mortgage, so that's again, I did a bunch of buying and added to my position, and that's worked out very nicely. Semiconductors, I timed a lot less well, so that position I am red on, but not by too much. And then the rest here, is a various positions. But I'm feeling very confident in the tech exposure. I'm still almost 2 decades away from retirement. That to me feels like a very good place for my money to be, but I am planning on rounding out the portfolio over the next few years. So you will see me sort of going for all worlds, and it's hardly going to be too safe. I don't think, even though it's a lot of this is ETFs. You'll see as well here that there are lots of positions. Like maybe you'll ask, like, why don't you just put it into an all world tracker and be done with it? But I'm trying to outperform using thematic ETFs, places where I think that I might not be able to pick a winner. But I think the sector is going to continue to grow. A good example of that would be the semiconductor position. But also, my wife works in private equity, so I have restricted trading, so I'm no longer able to buy individual positions. So to me, the only way I can possibly outperform the market is thematically. So we're going to give that a go as well. So it kind of aids in my excitement a little bit, to be honest. Um, just then to summarize something I touched on specifically with the copper position, but overall here the percentage change, whether that's weekly, monthly, quarterly, or yearly, these are taken from Google's finance sheets and are not my position. So yeah, just something to be mindful of here. You can, however, though, see that sort of although we've had a pretty good month as things have recovered, especially quarter on quarter and even to some degree year on year, things are still quite red. We're still sort of coming out of what was quite a steep fall, but we're gradually rebuilding. And again, I use this as an opportunity to add, more than 50 grand into this into these portfolios. So feeling absolutely fine that that's the way to go. Yeah, touched on this already. And then lastly, my focus, as I've mentioned, is on tech. I also still continue to like small caps. A lot of my smaller positions, for individual companies certainly are on the smaller side. If I look at Gamma, for example, I think the market cap there is about 1.5 billion. Games Workshop, something similar. Genius Sports, a few billion. But these are small companies that I think are very good or have a lot of promise to them. Amcor's had a difficult year, like they built a factory in Vietnam, and then suddenly that's one of the places that's being targeted with the tariff, so that's slightly awkward. Now, luckily, I did sell down a fairly significant portion of my holding. Once I had like 700, I think, in Amcor, so I've been selling out sort of in the low 30s. So yeah, to see this now down, I think $17 is a little bit different. That's a very red position for me at the moment, down about 20%. But we're keeping the faith with our remaining holding, at least for now. But yeah, so smaller caps, a bit more of the rest of the world, shall we say, and I'm also kind of taking some bets on some commodities, specifically copper, and the nuclear ETF there has a lot of uranium in it as well as nuclear, which I think is one of the aspects of the future. But that's my approach. The other interesting things I've been buying, I think, are the Indian position. I'm really happy with my buy price here. This is quite an expensive ETF to buy, but I think again, economically it makes sense to do so. And I was buying on sort of the political uncertainty there and any kind of like worries about tariffs or things like that. And so I've actually been able to build up quite a sizable position at the 950 or so. So there I'm already fairly comfortably green on what's an expensive fund. So yeah, I'm happy with my buys really. One or two of my sells I kind of regret. Like you might be aware here that I sold Hollywood Bowl, and that one I kind of regret a little bit. I did put it straight into Alliance, so it's done kind of okay. But that company again is an amazing small cap, micro cap really. It's like 500 million. But that one I kind of regret because now that I've sold it, I can't get it back. But I think that's my only regretted sell, and that's I'll have to just live with that as a consequence. By the way, I very much expect now Hollywood Bowl to go on a bit of a tear now that I've sold it. For anyone who wants a cheeky tip there, but a good company for sure. But mostly I'm happy, and we keep on progressing, and we try and beat the market. And next couple of graphs are going to show you how I'm doing in comparison to that. All right, so we're going to start with this. This remains my most important graph, I would say. However, it has become less important now that I can no longer buy individual shares, and I've not been able to buy individual shares for a couple of years now. So yeah, we are just focusing on the thematic, and I think for me, like that's still an okay approach as long as I don't massively underperform. But you can see here it feels more or less the same in terms of the what I've been saying for ages, which is I continue to sort of not quite be able to catch up with the S&P, but also still comfortably beating my other comparisons. The other comparisons being the FTSE 350, the All World, and then the UK CPI and bank interest as well as kind of estimate. So comfortably above all that, but I haven't been able to overtake the S&P 500 other than like literally one afternoon over the last many months. So you can kind of see it there right at the peak that I had. But since then, Gamma had a fall. I think one or two of my other big position, well, Alliance was down like 35% at one stage. So yeah, so that's caused a bit of a fall back. But you can also see I'm bouncing back a little bit quicker. So maybe we'll be able to catch up again in the not too distant future. But again, I feel pretty okay with this. I still think it is my most important, especially if I do want to kind of have a little bit of exoticness with the thematic ETFs. So I do keep an eye on it. It does still matter, but it's less important than it used to be because it's now not about the individual shares, but more about the funds. Um, and yeah, I think here it doesn't make me want to change or anything else. My approach, I still enjoy actually digging into some of the funds that I hold, especially my larger funds. The Allianz SMT and the Vanek semi position. Like those, like I say, that's half my portfolio between those three. So those three are going to have an outsized impact on how we're doing. But there's some cool companies in there, and we would be investing in several of them if we could still invest in large companies. I think, especially at the moment, Google to me is a slam dunk for a buyer. Would absolutely be buying Google. Same with Amazon, probably Microsoft as well. I would still be buying, even though I think that's a bit expensive. I'm not sure I'd be brave enough to buy Nvidia. I've never held Nvidia as a single position, but I have gradually become more bullish on it and more understanding of some of the more bullish prices, shall we say. But yeah, I'm happy to invest like this, and this is my way of enjoying it and getting more involved just to see if we can outperform. So we spent many years, honestly, catching up after we were pretty hammered from our Russian mining exposure several years ago, I think for obvious reasons. But we've never quite been able to sort of overtake, and you can see at the moment we're modestly behind, but feeling okay with the direction of travel. Okay, and then just to round it off here, my final couple of slides. You can see in the first graph here, this is my profit over time. So we had been north of 80,000, and then we had a huge drop most recently. By the way, the flat line is just the rest of 2025, so that will auto populate as the year goes on. Much standard stuff, but for anyone who's new. Also, as well, here on the profit slide, I still separate out between UK and US, but that's where the position is located. So, for example, Allianz Technology Trust, even though it's overwhelmingly US tech, that's a UK position because it's on the UK stock exchange. So just to explain how that works. So again, the breakdown here used to be more important, but now actually I only have a couple of positions in that are US listed, specifically Genius and Amcor are my only two US positions now, so it's slightly not really an important split anymore. However, the dark green line definitely does matter, and you can see there a massive fall from sort of north of 80 to less than 20 over a very short period of time. We are since rebounding quite quickly. But we've been through falls before, and I now struggle to see them on the graph. Like the one that's about a quarter of the way along there, that fall, that was when Ukraine was invaded. And that was quite scary. That was the first time, and up until then it had been relatively smooth. But again, we've been through this now long enough that even sort of very large falls, when you zoom out, look quite modest. And yeah, for me, it's just part of becoming, I guess, a more sensible, matured, experienced investor. I'm almost 5 years in now, so I think I can just about use that title. But yeah, I can't even see sort of the initial year and the sort of any falls there. And I do remember the first couple of falls. I was like, my goodness, I'm in the red. I'm new to this. How am I going to explain this to my wife? And now, it's just like, okay, I'm in the red, or I've lost 50 grand. And they're just ones and zeros on the screen, right? I haven't really lost 50 grand. But it is a slightly surreal feeling when you're dealing with these kind of numbers because they are big numbers. Even if you're sort of relatively comfortable, six-figure portfolio, and now I'm sort of relatively regularly having five-figure swing days, like losing. The portfolio is going down 15 grand in one day and then 12 grand up the next day, and it can many five-figure swing days now. So I guess I have to get used to it. But it is something to get used to when you're doing this. So yeah, the top graph is these are actually daily snapshot figures. So they're pretty accurate. You can see they're fairly jagged. But at the end of each day, I basically do a snapshot, and that becomes the kind of movement for that day. So you get pretty granular view. The bottom graph is done by month end closing, so that's a lot smoother by comparison. And here I think you can really see the impact of the deposits and the fact that, we're not yet back at an all-time high in terms of profit. So the green there is our capital. You can see the big jump there in terms of our 52K in April. And just to remind, that's 40K into ISAs, which is the maximum for me and my wife in a year, and then 12K into the GIAs. So yeah, so that's the big jump there that you've seen, toward the end. But you can also see that the blue figure got significantly squeezed, especially in April. It has started to widen again now, but still you can see it's not as wide as it has been before that pretty sharp fall. And yeah, that we're recovering. So the blue line there is basically our profit, both realized and unrealized, by the way. And then the sort of pink color magenta, I guess. That's our dividend. So that will never go down. But I'm not really a dividend investor, to be honest. It's nice to get dividends. I got like a £500 dividend from my the Frogmorton UK ETF. I think it's my fourth largest position. So I got a £500 dividend. That was very nice. But I'm not exactly a dividend investor, so that's kind of just a nice to have, kind of, I guess, the cream on top. Much more important to me is the blue line, and again, that has been better, and I hope it will go back up. And honestly, I'm really happy with almost all of my buys. Could have been slightly more patient on the semi position, but honestly, I don't really regret it. You can never time these things perfectly. Timed my copper position virtually perfectly, my banks position almost perfectly. India was pretty good. Um, what else do we have there? The SMT position was also really good. AA to the Alliance Technology Trust a little bit early, but again, overall, I'm kind of going to give myself, a solid B plus, which, considering I can't actually tell the future, I'm relatively happy with. But to be honest with you, like, a few people were asking me, like, am I going to regret putting in 52 grand if the prices went down? And of course, I would have been like, oh, if only I'd been a bit more patient, like with the Vanex semi position. But I was really happy to buy at these prices, like um, picking up these things at 30% discounts on what they'd previously been, and like comfortably 20% less than I would have been willing to pay, just felt like a great buying opportunity. So my attitude was like, well, I'm happy to buy these now regardless of what happens tomorrow. And that was that. Like, I mean, again, I would rather have bought things optimally and perfectly, but that's just unrealistic. And I'm sort of just trusting the process, and the process and all of the history tells me that, 2 out of 3 times it's better to buy as soon as you can. And because I was in a position to do so, I did, and that was basically my thought process there. So no regrets. A little bit of sadness that I didn't time things perfectly. A little bit of sadness that I've had to say goodbye to Hollywood Bowl. But yeah, we're pretty happy with the direction of travel at the moment. I'm not expecting any major capital additions over the next many months, frankly. But I am quietly confident over the next, well, certainly a couple of decades, but also a couple of years. The portfolio is in a pretty good spot, and now we just have to sort of be patient and wait. So that's where we are. Thank you very much for listening, everyone. Hope that was interesting. Any questions, fire them down below, and I will do my best to come back to you. Thanks very much. I've been the Boss Hog, and good luck with your investing. Bye for now.